Hey, it's Darren with Arbitrage Trade. It's time for Deep Dive with Daniel, who basically decided he would visit the U.S. this week. I mean, thanks for coming into the country. Did you have any problems with your passport or anything else like that?
No, it's
No?
very easy coming back. It's great. Every time you come back into the country, they always say, "Welcome home."
Aw, nice. And see you later, Gator, when you leave. Let's talk about your blog this week, and it's one that I asked you to do because and anytime I don't understand something, most likely there's a lot of other apes and people out there that aren't really up on the markets that understand either. And it's also a term, and anytime they very rarely use it on CNBC or financial TV, then I usually think it's probably pretty important, or else they would bring it up more often if it were not. So this one actually is, and the title of your blog is "What is a Bull Steepener? Understanding yield curve." What's the rest of it? Yield curve. Look at that.
Sorry, I
That's
don't
funny.
have
That's
understanding
funny.
yield curve shifts in simple terms.
Thank you. It was, the longer titles, it's harder to have memorized. Uh, so anyway, let's explore that. Bull steepener, is that like when you drink some bull tea, you need the steepener or what? What I mean, kind of explain what is a bull steepener. And the reason I say this once again is because it was brought up, I would say about, and we can kind of look at what actually happened back then, but about a month and a half ago, one of the guests on TV said, something about he believes we might be in a bull steepener at that point. So you can kind of do the correlation between a month and a half ago or two and what the definition of is now, which we're about to discover. So go ahead.
Yeah, so a bull steepener is essentially when you're looking at the long-term bond price. So, you can think of like the 10-year bond, that price going up quicker than the short-dated bond, such as like a 3-month treasury or something. And so, normally we talk about bonds and we look at the yields on them, like the rate, right? So this is the inverse to that. As bond yields go down, the bond price goes up. So in this
Hmm.
particular stance or position that this person is talking about is, you know, they believe yields are going to get cut by the Fed, right? Which ultimately has the market price in a lower bond yield, which has people price in a higher bond price. So it's essentially a flight to safety trade, which is a bullish bond trade, right? Now
Right.
that does not necessarily mean, and to be, just to be more clear, it's bullish on the long dated bonds, a little bit less bullish on the short dated ones, which makes the curve between the two steeper, right? Because it's one minus the other. It's not just looking at one of the bonds; it's relative to another. And
Yeah.
this is bullish for bonds. That does not mean it's bullish for the rest of the market.
I know that in general, higher the yield, the less beneficial it is for stocks in general. If you just look at a macro, but here you're being specific to short dated versus long dated bonds. And I mean, just as a one aside, I do know that it was kind of a crazy $1 billion worth of 4 week bonds were just sold, and that's crazy. And so it seems to be that the shorter dated is more popular than the longer dated now. Does that seem to be the case?
Well, for a long time during, we'll call it from after COVID to
Hmm.
now, the short or the front end of the yield curve, so the shorter dated stuff, had a very high rate compared to the middle or the long
Right.
dated things. And so if you think about it, let's just say you can get 4% on a 3-month treasury versus 4% on a 20-year. Well, why wouldn't
Right.
you just
Right.
get the same thing on something shorter? And if the position
Sure.
changes, you can get out, right?
Sure.
And a lot of the shorter stuff is kind of just a product of liquidity.
Right.
Short-term
And
yield, wait for the
yeah.
market to, if you think it's going to go down, get a nice yield for 3 months, and then your cash is free and you can reinvest later.
So exactly, not having to wait. And I think you and I discussed recently, or at least I put it up, that the reverse repo or the repo facility basically had nobody.
Mhm.
So that's the opposite. It's like it's there's not a liquidity need, but then if you're selling shorter, I guess because like you said of the rate being good, that somebody needs the liquidity for the 4 week anyway. So like everything else in the last year. It's just like two different weird stories that are going on, and this seems to be one too. So just the you discussed anything else to say about the yield curve though at all?
Well, not particularly. So, just to reiterate, the bull steepener is looking at the inverse of the yield curve, right? It's looking at rates. Now, the interesting thing is, and we've talked about this on After the Bell quite a few times at this point, is that, the yield curve is back to being positive, right? So that actually makes
Yep.
sense that we'd be in a bull steepener, um, especially as the rates are starting to potentially change, right? Market is pricing in an 87% chance of at least a 25 basis point cut this month, right? And so if we're expecting a rate cut, yields are expected to go down, which means the bond itself price goes up, which can create a bull steepener, especially if we're looking at a longer term, trajectory of lower rates.
Yeah, I know. I remember also in After the Bell, you discussed, you gave the history of yield curve inversion, and that 6 months after is when's the danger point, right? And I feel like that's where we are now, or maybe it was
Yeah, it's like 6 to 18 months about
18.
after.
Okay, wow.
Yeah,
Okay,
yeah, yeah. It can be pretty short to pretty decently long, right? Year and a half about.
okay.
But after it reverts back to being positive, typically somewhere within that time frame, you start to see it's you can only really tell retroactively, but the signs of a recession, market crash, right? But historically, I think maybe only once has the yield curve reverted and not caused an issue. And the interesting thing about this time is it's one of the longest times it had ever been inverted. So,
Hmm.
is this time probably different? No, but like maybe because it was inverted so long, it takes longer to happen.
Gotcha.
And
That would make
just for
sense.
the history of the audience, whenever you have higher rates for a while, and then you start cutting, and depending on what you believe, they're cutting to get ahead of any bad economic news, which
Hmm.
debatably they can't stop. You are looking at your atypical rates are get cut, bad things are going to start to happen. They cut drastically. The market has to correct.
Yeah, and then of course, if hell happens, then they'll just blame, of course, Powell for being late again. Because I mean, that seems to be the scapegoat every time.
Well,
That,
like there is a part of his career where he was definitely too late, and
hmm.
the not everything is done, but you could say we've had a quasi soft landing. Like things have been relatively stable. That being said, like his job isn't done till he's out, right? You can't really judge him till
Yeah, it's
that
either a soft
that
landing
thing
or
could
a
be wrong in a month.
yeah. Well, yeah, yeah, yeah. But it's either a soft landing or a pushed forward disaster. We'll have to see which that is based off of the. I
Mhm,
mean, even now you've got the whole tariff variable that's in there, and now they're going to try to do another bull run because of the courts that are saying that they were all illegal. So now they're going to pull
mhm.
that back possibly. So there's so many variants that are happening right now, and here we are in September, which is when you guys all predicted a disaster might happen. So, and we have what 28 days to see, or
I mean,
27.
we didn't do After the Bell today, Darren, but
Right.
when I look at from where the last trading day of August to now is, we're down about 1.5%. So we kind of
Yeah.
gave back all those gains we had from that big day we had August 25th.
Yep.
And so things are starting to be a little bit textbook when it comes to seasonality.
Right, right. The VIX did fall back down below 17. There's just so many alternating signals. It's crazy. And of course, it's almost like the judge and the timing of everything with Google and Apple today, which is what basically held up the markets to where it was. It's like it's all planned out perfectly to keep the markets afloat. Let's use one of the the big seven to keep it afloat, if
And
nothing else
they
will.
need it after Nvidia.
Yeah, exactly, exactly. You did give actually, as far as specific bull steepener, though, you gave some examples, and it's interesting the times that we're talking about. So, what are those examples?
Yeah, so one is after '08, the Fed cut the short-term rates near zero, which, as you can imagine, makes the long-term bond go exponentially higher, right? Because they're like a seesaw. So there was
Right,
'08, there was 2020 during COVID, where once again they drastically cut rates to stimulate the economy because there was nothing going on. So it's always in these uh, periods where things are not going well or potentially are going to start to not go well that we get these interventions by the Fed. Rates go down to zero so people can afford to borrow to attempt to stimulate the economy, and bonds become more expensive because at least your money won't go to zero.
right, right. You mentioned bear steepener and bull steepener, so you did bring in kind of. It's not exactly the opposite, but it's pretty close. So, just recap on what those two differences are, and then we'll recap the whole thing.
Yeah, so it's the difference with a bear steepener is when the long-term uh, bond price falls faster than the short-term one. So you can think
Hmm.
of it as the long-term bond yield is rising quicker than the short-term one. So
Yeah, so it
it
has
really,
nothing to do. It has nothing to do with inversion at this point. It's just the rate of fall.
yeah, 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 we're just
Yeah.
looking at the long-term and short-term bonds
Hmm.
relative to each other and how they're moving against each other.
Right.
So
Right.
the like a yield curve inversion or going positive is simply just looking at the long term and short term relative to each other, and if
Yeah.
it's that number is positive or negative.
It has nothing to do with steepeners. That's just a separate event. But the fall of the rates is what the steepener is about, right?
Yep, yep.
Yeah. Okay. Or rise of the other,
Yeah, yeah, yeah.
whichever it is. So bull or bear. And so why in the world would I care as an investor about a steepener? Why does that matter? It does sound like something, especially because again, they didn't mention it a whole lot on financial TV. It's like that's one of their tools they don't want anybody else to know. Is that what it is? We can't have retail being educated here.
Yeah, so if we think about when has bull steepener happened in the past, we got '08, we got 2020. What happened
Hmm.
during those times, right? Those times
Hmm.
the market went down drastically, the
Yep.
economy wasn't very good, and so you can think of a bull steepener as the name is inversely related to what the market's going to do. But if bonds are doing well, the market's not going to do it well. It's telling you that there's a lot of risk in the market, and so you can kind of use this as an indicator of how, kind of the economics might be
Hmm.
going soon and how to
Hmm.
position yourself to either, kind of buy the dip, maybe hedge your portfolio on the equity side, or, if you trade bonds, you can trade the spread between the two of how you think they might move.
Yeah. So pretty much a another thing in the toolkit that and the investment houses probably want to keep to themselves, but we're outing them today as one more tool as a macro future event and being able to get ahead of that, which is what they always do. They always get in early. So maybe retail investors can get in early if they can use this as another tool in their toolkit. So I appreciate you bringing that in and deciphering um, what he brought up 2 months ago, and I was like, what the heck does that mean? And I got the very brief definition, but I didn't deep dive, which is what's reserved for you. So I appreciate you bringing that in with your expertise. for everyone. So looking forward to next week's deep dive so we can get even more education and be dangerous as retail investors.
Hopefully, we can come up with something a little more sexy for next week.
This is kind of sexy. I mean, anything that's hidden, and
Yeah.
taboo for us to know can be sexy. All right. Thanks, Daniel. I look forward to seeing you next week.
Catch you then, Darren.
All right. Bye.